So let's look here at chapter 9 on page number 282. Page 282, let's get into chapter 9. Now, chapter 9, this whole chapter is about government-sponsored financing. So in this whole chapter, we're going to be talking about the government loan programs that exist. And there are 3 government-sponsored loan programs that we should know for the exam. The 3 are FHA, VA, and CalVet. Those are the 3 government-sponsored loan programs that we're going to need to know for the exam. Now compare these government-sponsored loan programs with something at the middle of page number 282. At the middle of 282, you'll see the term conventional loan. Now, a conventional loan is a loan that does not in any way involve the government. A conventional loan is a loan that does not involve the government in any way. So I'm just mentioning that to compare the 3 loan programs that we are going to talk about, FHA, VA, CalVet, with conventional loans. Conventional loans do not involve the government in any way. Is FHA a conventional loan? No, it involves the government. Is VA a conventional loan? No, it involves the government. CalVet involves the government. It's not a conventional loan. Now, typically, with conventional loans, when, if you ask your grandmother, hey, I want to buy a house, grandma would tell you to have 20% down. Or more maybe even. A lot of people say 20% down. You buy a house, 20% down. Now, imagine where prices are today. Let's say the average sales price in your area is $400,000. If I told you as a first-time buyer that you needed 20% of $400,000 to buy a home, that's $80,000, you'd have a freaking heart attack. Most people, particularly first-time home buyers, don't have $80,000 to just put down on a house randomly, right? And the truth is, if you have 80,000 bucks, there's probably only one of 3 ways that you got it. One of 3 ways. Number 1, you good old-fashioned saved it up, which is hard, right? To save up 80 grand, just stacking away, that's hard for most people. Number 1. Number 2, you're just born rich. You come from money, your family has money, and that's how you have 80,000. Number 3 is you had a piece of real estate before. You sold it and you cashed out that money, or you had something that you sold and that provided you with that money. Now, most people, especially first-time home buyers, don't have $80,000 to save. It's insurmountable for most people. Number 2, most people aren't born rich. And number 3, most people don't have something they can sell, especially if you're a first-time buyer, in order to get your $80,000 down payment. So we have government-sponsored loan programs that make home ownership affordable for more people. The thing to remember about the first loan type that we're going to talk about, called FHA, is that FHA does not make loans. Super important concept to remember for the exam. FHA does not make loans. FHA just doesn't. FHA merely insures loans made by approved lenders. So the mortgage insurance on an FHA loan is not designed to protect me as the borrower, it's designed to protect the lender. So if you want an FHA loan, where do you go to get it? Well, you go to Bank of America or JP Morgan Chase or Wells Fargo, or you go to a lender to get an FHA loan. Big thing, FHA loans are not made by the government. They're simply insured by the government. Lenders make FHA loans. Now, what's interesting about this is I just told you that the mortgage insurance on an FHA loan doesn't protect the borrower. It protects who? The lender. So your question is, well, if FHA doesn't protect the borrower, why should I care about FHA? FHA is not there to protect me, it's to protect the lender. Here's why you should care about FHA. If you look at page 283, if you look at the middle of the page, you'll see the term total cash investment. The total down payment on an FHA loan currently is 3.5%. Now that's subject to change. For a long time it was 3%. It's currently, as of April of 2013, it's 3.5%. This may go up over time, but right now it's 3.5%. That is pretty sweet. 3.5% down to buy a house is amazing, right? That $400,000 home, I don't need $80,000 anymore. How much do I need? I don't know, 15,000 bucks plus or minus. You can save $15,000. It might not be in a month or in a year or even 2 years, but if you say, you know what, damn it, I'm going to buy a house in 3 years. I'm going to save up the $15,000 I'm going to need. You could probably save $15,000 just by cutting out the extra large latte and, maybe go into Redbox or watching Netflix instead of going to the movie. every weekend. You can save $15,000. So do real estate agents like FHA? We freaking love it. We love FHA. Why? Because FHA makes home ownership possible for more people by allowing lower down payments to get in to buy property. Now, one thing about FHA that's also important to remember, very important with FHA, you can't have more than one FHA loan at a time. So if I bought my first house conventional, I could buy my next house owner-occupied FHA and only put a 3.5% down payment. Now, FHA, as I mentioned, is a type of insurance. In all instances, for any insurance, your health insurance, what do you pay? You pay a premium. For your car insurance, what do you pay? You pay a premium. For your homeowner's insurance, what do you pay? You pay a premium. Same thing here. If you look at the bottom of page 283, there is a one-time payment paid to FHA at the close of escrow. It's called the FHA Upfront Mortgage Insurance Premium. It's paid by the borrower. Now, this is in addition to the 3.5% down payment. Now, can I wrap this into my loan? I can wrap it into my loan, no problem. So I can either come up with the MIP up front, mortgage insurance premium up front, or I can wrap it into my loan and pay it over the next, let's say, 30 years. So your natural question might be, well, how much is this upfront MIP? Now, the book here at the bottom of 283 says that the upfront MIP is a 1% of the loan amount. Now, this is a recent edition of the book, but the upfront MIP amounts change over time. So right now, as of April of 2013, if you have a loan for 30 years with FHA and you are putting 3.5% down, it's actually 1.25%. So this mortgage insurance premium has gone up over, since this book was published here. It's gone up. It's 1.25% now, and that's subject to change also. Now, it could be less if it's a 15-year loan, so you'll work with your lender to figure that out. But currently, the upfront mortgage insurance premium is 1.25% of the loan amount as of April of 2013. Now, there's also on page number 283 at the top of the page, FHA loan limits, maximum FHA loan limits. You cannot get a $5 million FHA loan and put 3.5% down, let's say. The FHA loans, the limits vary based on county. FHA loans vary based on county. Now, LA and Orange County have the highest FHA loan limits of any county in the entire state. And you'll see this chart on 284, 285. LA and Orange County, the FHA loan limits are over $729,000 and change. So you'll see this for a single family home, a duplex, a triplex, or a fourplex. You can get FHA loans for residential 1 to 4 unit property, but the maximum loan amount that you can get is going to vary based on location, based on the average sales prices in the area, and it's also going to vary based on how many units you want to buy. Now on page numbers 286 and 287, you'll see at the top of 286 that says interest rate and loan term. Now candidly, most FHA loans are 30-year fixed rate loans, especially because of the low interest rate environment that we're in today, and you'll see that on page number 286. Now, prepayment penalties at the middle of 286, FHA loans do not have a prepayment penalty. So the borrower can sell, refinance, or pay off the loan at any time, right? So FHA loans do not have prepayment penalties. Another thing I would look at the bottom of 286 is points. Sometimes borrowers, in order to buy down the rate, may have to pay something called discount points. Now, 1 point is equivalent to 1% of the loan amount. So if the lender charges you a point to originate your loan, that's called an origination point. That's just commission, basically, or money that you pay to the lender for getting that loan through, right? That's called an origination point, 1% of the loan amount. The book on 286 also talks about discount points. Now, a discount point is also 1% of the loan amount. It's a point. However, a discount point is used to buy down the rate. So the lender might say, hey, look, the interest rate is 4%. However, if you pay me a discount point, I can get that down lower for you. So you could pay money in advance, prepaid interest essentially, to buy down that rate, and that's of course known as a discount point. Now, if you look here on page number 288 and 289, one thing that I would note on 288 is this gray box at the top of the page. These are buyer qualifications for an FHA loan. The seller is only allowed to contribute a certain portion to the property. There's certain costs that the buyer is allowed to pay or not allowed to pay. in connection with a lot of FHA loans. So these vary based on the half a dozen or more types of FHA programs that are out there. But big picture about FHA, what do we need to know? It's not a conventional loan, meaning that it has some element of government participation. But is the government actually funding the loan? No, the government's not funding the loan, FHA. Who's funding it? The bank, right? Now, banks, Wells Fargo doesn't like making loans to people that only have 3.5% down. Why are they okay with it in this case? Because the government's insuring it. They're saying, look, Wells Fargo, make Charlie that loan. If Charlie doesn't pay you, FHA will cover you. Now, in order to get that insurance, you are going to have to pay an insurance premium to do it. That's called an FHA upfront mortgage insurance premium. Right now, that's generally 1.25% of the loan amount for the upfront mortgage insurance premium. We have loan limits for FHA on residential 1 to 4 unit property. These depend on what county you're buying your property in. FHA loans have no prepayment penalty associated with them. So let's move out of this FHA discussion into a discussion regarding VA. So we'll move out of FHA into VA. Now, VA, unlike FHA, requires that you be a veteran in order to qualify. You will need something at the middle of 289 called a certificate of eligibility. So in order to get a VA loan, you need a certificate of eligibility saying that you are entitled to veterans benefits. Now, just like FHA, VA loans are not made by VA. VA loans are made by a lender, Wells Fargo, Bank of America, JP Morgan Chase, and they fund the loan. The VA merely insures the loan to protect the lender. Now, a couple things that are important here on page number 290 and 291. If you look at page 290, the certificate of reasonable value. So the certificate of reasonable value is basically a fancy way of saying an appraisal for a VA loan. Now, the coolest thing about VA, frankly, is if you look at page 291, where it says down payment and closing costs. The down payment on a VA loan is 0. VA does not require a down payment. FHA is going to require 3.5%. VA requires no money down. Now, we talked in Chapter 8 about a concept called loan to value, the loan to value ratio. Now, the loan to value ratio is a ratio of the loan amount to the value of a property. In the case of VA, if you're putting 0 down, you're buying that $300,000 home and you're putting 0 down, that's 100% loan to value. It's 100% loan to value on page number 291. There's a question on the exam. The type of loan that permits a borrower to borrow up to 100% of the appraised value is what? VA, not FHA, but VA. Now, FHA, remember I told you FHA charged that mortgage insurance premium, that one-time payment paid to FHA at the close of escrow. VA has something similar. The VA product has something called the VA funding fee at the middle of page number 291. So, and that funding fee is going to vary based on how often you've used your VA benefits and all. But just like FHA's mortgage insurance premium, we can wrap that VA funding fee inside of the loan. We can wrap that VA funding fee inside of the loan to make it a truly 0 down deal for that particular veteran. Now, if you look at page number 292, one thing I would show you here, these are differences FHA versus VA on page 292. Very important concept here. Loan amounts, VA guarantee limits do not set the upper limit of the loan amount, whereas FHA has that loan amounts that vary based on the county that the property is located in. Now, either way though, even though FHA only requires a 3.5% down payment and VA requires 0 down, the lender may require a down payment. If you want to buy a house and your income's kind of small, the lender may say, look, in order to fund this loan, you got to put money down to shrink the payment so that it qualifies with your income. For example, on page number 292. Now, in both cases, if you look at the bottom of page 292 where it says loan prepayment, there is no prepayment penalty for FHA. Similarly, there's no prepayment penalty for VA as well. Now, the third type of government-sponsored loan program we're going to talk about on 293 is CalVet. Now, before I can get too deep into CalVet, I have to just review something with you from Chapter 8. Remember, anytime a loan is made to purchase real estate, there are 2 documents that are issued. There's a promissory note and there's a security instrument. The promissory note is the borrower's promise to pay. The security instrument hypothecates. It pledges some asset as collateral, so if you don't pay, the lender can take that asset to satisfy the debt. Now, FHA and VA use those documents, a promissory note and a deed of trust. CalVet is different though. CalVet uses a separate kind of financing instrument called a land contract. And before I can get too deep into CalVet, I do want to talk about a land contract with you here on page number 296 and the top of 297. Now, what is a land contract? First of all, one note that I would make at the bottom of 296 for land contract, no bank. A land contract does not involve the bank at all. There's no bank involved. The best way for me to explain this is with an analogy about a car. Let's say, for example, that you wanted to buy a 1963 Volkswagen Beetle. Pretty cool car, right? Especially if you're a little older, right? You might have fond memories of that car. Now, if I went to my bank and I told Wells Fargo, I would really like to get a loan to buy a 1955 or 60 or 63 original Volkswagen Beetle or Bug. What do you think they're going to say? Even if I have great credit and amazing income, they're going to say no. They're not going to loan me money to buy a 50-year-old car, and here's what. If they had to repossess that car because I didn't pay, the bank is going to repossess it from me. I'll be in Target doing some shopping. I'll come out and the car's gone. The bank isn't going to keep that car. The bank is going to sell it and apply those sales proceeds to hopefully satisfy my debt. How easy do you think it's going to be to get a buyer to buy at an auction a 50-year-old Volkswagen? No way. That's a specialty car. Only a few people are even interested in a car like that. But if I wanted to get a loan to buy a 2013 Volkswagen or 2014 Volkswagen, they'd give me that loan all day. But not to buy a 50-year-old one. But here's what I could do. I could go down to a local car dealership that has these big balloons and banners and these signs that say, we carry our own contracts, your job is your credit, etc. And I could walk into that car dealership and maybe they have a 55-year-old Volkswagen on the showroom floor. I go up to the salesperson, I say, hey, how much do you want for that car? I tell the dealership. Dealer goes, man, this is a special car. This was the owner's car when he was a kid. We want $10,000 for it, let's say. I tell them, look, I don't have $10,000, but I got $5,000. You want to take $5,000? The guy's going to say, no, beat it. I'm not taking $5,000 for this car. It's $10,000. But he'll tell me, look, you know what? Here's what I'll do for you because I like you. He'll tell me, you put $5,000 down now. Take the car. We'll finance the other $5,000 on a contract. Now, I'll pay him $5,000 and I get to drive the car today. But what's the car dealership going to hold on to? They're going to hold on to the pink slip. The title to the car is going to stay with that seller until I pay off the contract price. So in a year when I pay off the other $5,000 plus interest, they will mail me the title document. The real estate could also be sold the same way. There's no bank in my story. The seller carries back for the buyer, no bank involved, and the seller gives the buyer possession right away. I get the car right away, I get the land right away. However, the seller, acting as a lender, is going to hold on to the title to that property until I pay off the balance. All I'm going to get is an equitable title. I'm going to get the opportunity to build equity in that property. The actual title, the legal title to that land or building or house is going to stay with the seller until I pay off that contract price. So now that I told you about land contracts, that brings us to page number 293, and let's talk about CalVet. CalVet actually uses a land contract. This is different than FHA and VA. FHA and VA use promissory notes and trust deeds. A CalVet loan uses a land contract, and here's how this works. A veteran goes out and buys or picks a house that he wants or she wants to buy. The California Department of Veterans Affairs actually buys that house for the veteran and then sells it to the veteran on a land contract. So that's how this works. The government buys the home for the veteran cash. The veteran then pays the government back on a land contract. Now, hearing that, you might think to yourself, wow, I thought California was broke. If we have no money, how do we have cash to buy homes and farms cash for veterans? The program, if you look here at the middle of page 293, see where it says CalVet loans in bold? In that paragraph, you'll read the whole CalVet program is self-supporting. It's not funded by taxpayers. It's funded by revenue bonds. So the state goes out and sells bonds to investors. Now, what's a bond? A bond is like debt. The state goes out and sells bonds to investors and promises them some rate of return. Now the state has cash, right? Because we traded, as a state, we traded these investors bonds for their cash. Now we got cash. The government then turns out and uses that cash to buy the houses and farms, then sells them to the veteran on a land contract. Now, is the veteran going to be paying the state interest on the land contract? Of course. Is the state going to have to pay those investors interest on the bonds? Of course. Now, conceptually, if we're going to pay out, let's say, 3 on the bond, we got to be collecting something like 5 or 6 from the veteran. You can't pay out 6 and take in 4, you go bankrupt. So this is how CalVet works. CalVet uses these bonds to buy homes and farms and then pays the investors interest on those bonds with the money that they collect on the land contract. Because I had to tell you all that to get to this. The interest rate on a CalVet loan may change annually. Depending on the cost of the bonds necessary to finance the program, the interest rate on a CalVet loan may fluctuate. Now, if you look at the bottom of 294, you'll see this. It says interest rate and loan term. Depending on the cost of the bonds necessary to finance the program, the interest rate on a CalVet loan may change annually. Again, just a global overview. FHA, VA, where do we apply? We apply at a bank. CalVet, where do we apply? We apply at California Department of Veterans Affairs. An applicant for a CalVet loan would send his application to the California Department of Veterans Affairs. Different from FHA and VA. FHA and VA, you go to a lender. CalVet, you go to the state. So a couple of last things from chapter 9 here on page number 297. One of them is called an AITD, or an all-inclusive trust deed. Let me give you an example of how this might work. Let's say that my house costs $200,000. I'm selling it to you. I have an existing loan of $150,000. You're short $50,000. What I could do is I could make you as the buyer sign a promissory note and a deed of trust for the full $200,000. So that's going to include the payments that I'm making on my $150,000, in addition to a portion that you're going to pay for the $50,000 I'm financing for you. That's called an all-inclusive trust deed, or a wraparound mortgage. So my first loan of $150,000 stays, along with a wrap that you're going to pay me on the other $50,000 that you're short. You as the buyer are going to pay me for the full $200,000. You're going to pay me hopefully early in the month, because once I get that money from you, what am I going to do? I am going to pay my lender, because remember, I still have obligations on the first. So an AITD, or a wraparound loan, is where you leave the first loan in place, have a secondary loan for a wrap for the equity portion that the buyer is buying. The buyer sends that money to the seller for the full amount, and then the seller pays the bank. Now, this was quite common many years ago. This has not been common in the last probably 10 to 15 plus years. And the reason is because most loans today have something called alienation clauses in them, or due on sale clauses. So the minute I sell that property to you and you're paying me on that wrap, if my lender on that $150,000 finds out that you bought my property, what are they going to do? They're going to call the loan. They don't know who you are. They don't know if you have good credit or bad credit, or if you're rich or you're poor. They have no idea who you are. So when they find out that I've sold my property to you, they're going to call the loan. That's kind of why you don't see this very much here in 2013. Most loans have these alienation or due on sale clauses built in them. But what is a wraparound? It's where you leave, or AITD, all-inclusive trust deed, you leave the first loan intact, wrap around for a second loan for a portion of the difference, or all of the difference, and the buyer pays the seller that amount, then the seller sends that money off to their lender. It's called an AITD, all-inclusive trust deed, also known as a wraparound. So page 299 here, last thing we're going to talk about in chapter 9 is the secondary mortgage market. Now, the two things I would write about the secondary mortgage market at the top of 299. The first thing that I would write is I would write the words frees up capital, F-R-E-E-S. The secondary mortgage market frees up capital in order to make new loans. Now, how does this work? If let's say that I'm Wells Fargo and I have a bunch of loans. Let's say it's $50 million worth of loans. The problem with having a lot of money out in mortgage loans, and 50 million probably isn't a lot to Wells Fargo, but let's say it's $1 billion out in mortgage debt. As new buyers and new borrowers come to me to want to refinance or buy property, I might feel like I'm too heavy in mortgage loans already. So a lot of the time these lenders do is they'll bundle these loans together and sell them on the secondary market. Now I'm Wells Fargo, I can get my money back. I sold these loans to another investor, I get my money back, and now I'm freed to make new loans. So what is the secondary mortgage market? It's the transfer of existing loans between investors. The transfer of existing loans between investors. Wells Fargo sells to Chase, Chase sells to One West sells to whatever, right? So that's the transfer of existing loans between investors represents activity in the secondary mortgage market. Now, there are quasi-governmental entities like Fannie Mae and Freddie Mac that help to keep the system oiled, to keep money flowing through the system. Now, a lot of people say, man, we should never allow this. This is what caused the demise of the mortgage market, all these loans being sold. Loans have been sold in the secondary market for decades. What screwed up the market is making loans to people that had no business getting them. What screwed up the market is making loans to people that can't prove their income or don't have tax returns or whatever. So we need the secondary mortgage market to keep money flowing through the system and to keep our system well-oiled. If every lender had to keep all their loans forever, they might not make new ones because they can't get rid of the ones that they already have. That's the secondary mortgage market. It frees up capital and it transfers loans between investors.